Uh, Andrew, can you tell about your experience of using an application?
Yeah, the first one was with the enable feature. When I tried to give access, to give
Mm-hmm.
permission to Atomica pool, keeper pool, to access my DAI, I saw the 99999, some big figure, and that set a kind of alert to me, and uh, I lowered the level to 500 DAI. And
Mm-hmm.
then when I got more DAI from your pool, test DAI, and tried to add them into the pool, I couldn't do that. I tried to search the link, but it never appeared. So I made a report to you in DM. And one more feature was the balance.
Yeah,
First, I
yeah.
submitted 500 DAI, and I saw 468 with some zeros, and in the parentheses I saw another sum. Can you explain to me what's the difference between the sum and the sum in the parentheses?
Yeah, sure. As I also answered to you in direct messages, yeah,
Is
it's
it
a
a bug?
bug. Yeah, it's
It's
a
a bug.
bug. Yeah, it's our first version, and we immediately figured out like yesterday. Yeah, and we hadn't have a chance to fix it. Yeah, but it's a bug. We do not charge any fee. So basically, if you deposit like 100 DAI, immediately you will get your balance like 100 DAI.
Okay, I got
But
you.
yes,
And what's about the first bug with the enable feature? Is it uh, is it normal across the industry, or did you implement it specifically for the keeper pool?
yeah. So basically, yeah, you have an option to set your custom allowance uh, for the contract. Yeah, but also I answer to you that it's a bug as well. We will check it. Basically, if
Mm-hmm.
you're entering the amount which is higher than your current allowance, you have to receive the message that you have to increase your uh, allowance. So basically, like this
It
initial
should be
enable
displayed.
mess. Yeah,
It should be
it
displayed
should.
automatically.
Yeah, it should be. But yeah, as you reported, it's not. So yeah, it's a problem. Thank you. We will fix this.
Because I wouldn't feel safe allowing anyone full access, unlimited access to my balance, because I'll have to set up two wallets in this case.
Yeah, sure. I
It's
understand
not
you.
convenient.
Yeah, I agree. Yeah, it's possible to set this custom allowance using like MetaMask, but I guess it's a bug that it wasn't shown to you that you can modify it. But yeah,
Yeah. And one more thing about the auctions. So you induce them automatically, right?
sorry.
About the test auctions.
Uh,
Uh,
e- yeah, and
who who
what is the
starts
question?
who starts the auctions?
I see. Yeah, right now, considering that we deployed our own makers contracts, right now, only we can manipulate this ETH price, and the auction should start automatically, whether this ETH price goes down. But considering that like right now or in the moment you were doing this, no one uh, launches this Ethereum price goes down or CDP open, so there is no auction in this case.
Did you find?
So
Okay,
sorry?
thank you. Did you find someone to audit the smart contracts?
Right now, it's our open question, and also it's related to the grant strategy. As we discussed, also this question is on the agenda for today. Yeah, and considering recent hacks, it's one of our main priorities to have audits and to be sure that the contracts are secure and safe. That's why right now it's testnet in early beta mode with restricted access, and also we once we launch on mainnet in first period of time, we also will have this early beta mode with provided access until we will have contracts audited. So right now it's an open question.
Okay, thanks for now. I'll switch my mic off.
Yeah, we will discuss this grant strategy, and so we can get funds for the audit later today. So yeah, we can discuss it more precisely. Okay, so I suggest to start. So welcome everyone to the 7th community call dedicated to the Keeper pool. And we are so excited about recent announcement we did today that Keeper pool is under early beta mode, and it's possible to try it right now. To do this, you just visit the website that you can find in a pinned message in Telegram and sign up for the access. And you can try the Keeper pool on testnet. And even more, it would be great if you would like to participate in the in-person 30-minute interview, so we can hear your feedback in real time to design the product even better before we go mainnet, because we're doing for not for ourselves but for the community, and it's really important to hear the feedback, what you would like to see, what is crucial for you to have, so you can supply your funds safely. So yeah, to do so, if you would like to participate, you can also check the pinned message in Telegram group and book a conversation via Calendly, or just drop your email, or just direct ping me in direct message, and we can arrange a meeting and the time which is comfortable for you. Yeah, and we have, as I mentioned, answering the question, Andrew's question, we have plans to go to mainnet in like a few weeks when everything will be ready from our side, but it will be also in early beta mode until we will have our contracts audited, so to prevent any huge losses. So yeah, to get the early access, you can do in the same way. You just provide your contacts via form you can find at the website. That's pretty it regarding how to get access. And we can move forward through the agenda. So I'll provide a quick overview what we achieved since the last call. As you remember, if you were during the last call, we presented our first end-to-end demo of the Keeper pool on testnet, and since that demonstration, we spent most of the time making fixes of the bugs, and also Sorry. Yeah, also we started studying the integration process with 1inch exchange. Also, we discussed this challenge we have, how to sell one collateral in the most efficient way, because right now we are integrated with Uniswap, which is a great exchange, and but in some moment of time it can be hard to sell a huge amount of assets with a convenient price, and it's very important part. So we were considered different solutions. Among them, there were 3 DEX aggregators, 1inch, Total, and DEX AG. All of them are like pretty cool and have more or less similar functionality with some differences. But right now we stick with 1inch. So maybe anyone has some relevant experience why we should pick this exchange for sure, but not this, because of 1, 2, 3. It would be great to hear, because if anyone had some experience, it would really help. So yeah, but right now we picked 1inch and move forward to integrate with them. Also, we are started studying the opportunity with the asset manager, and asset manager is the element of architecture that's responsible for allocating assets in periods of low volatility to retain yield that DeFi market has in this moment, like compound or DSR. So yeah, we're looking for some protocols that may integrate different solutions in one product, some kind of yield segregator, to reduce our costs and efforts to integrate in each protocol one by one. So also we were considering different protocols like Ray of Stakehouse, DeFi Zap, or Meta Money Market, or token set. But right now we also stick with not also, but we stick with idle. Right now they contain compound and AVE and support two assets, and we assume that this integration like would provide different protocols and assets for keeper pool users much faster that we will do it by ourselves. So right now we also are investigating this opportunity for integration. Yes, that's pretty are the main updates from our site. Also we are did some modification for our bidding strategy. They were some minor, but very important to us to go to mainnet. And if I'm not wrong, this document is we shared this document, so you can also check the progress there and provide your ideas if there are any. Yeah, it's the main updates from our side this week. So yeah, the main part was to provide the public access to this beta of Keeper Pool, and we did this announcement today. So you can go to the pinned message in Telegram and sign up for the access, and our team will contact with you shortly. Okay, and we can move forward through the agenda. We have a few questions today we would like to discuss. One of them is grant strategy. We started working on a grant strategy for a maker, and So it's also linked with the question of contracts audit, and yeah, we have some questions, and Renat, you wanted to discuss this question. Maybe you can start with like some questions you would like to cover.
Yes, I would like to ask for feedback on the requirements towards oracles and APIs that could significantly enhance profitability of bidding strategies, or that could significantly de-risk and address some of the risks as outlined in the risk framework. The second part, I could give a quick update on the status of our grant applications, and that would be the two items from my side. The first one is the oracles, and I would like to ask question a question to to our engineering team that will get to the integration of these oracles as soon as we stabilize the contracts and pass it on to the audit thread. The question number one is, among various oracle ideas that we discussed previously, some of them could either enhance profitability of liquidation operations, some could address the risks, some can do both. The question is, which of the oracles that you see as the priority number one, what would be the priority number two, and number three, what you believe the ability of integration of these oracles allow, so that we prioritize not just according to what could deliver the greatest impact, but what would be the easiest and fastest to integrate right now. Maybe Konstantin, could you, what do you think?
Yeah, hi Renat. As far as I see, nobody of our engineers is present here, but as for me, I guess that may be two most important things that we face right now. We need monitoring oracle for gas prices, and maybe another one to adjust our bidding and to monitor current exchange prices, to know the latest info that we can actually bid for.
Mm-hmm.
And by saying gas price, what exactly do you mean by gas price? What like general network, like fast gas price, or it may be current competitors' gas price set that we can like, check in mempool,
yeah,
or
yes, we discussed previously that the most important here would be checking mempool and the gas that is expected to be used for the fastest transactions at the moment.
Mm-hmm.
Okay, and
Because gas costs can be very important if there are huge loads. It has not such an impact, but these days I'm working on the analysis of the latest auctions that we have some statistics about it. And there is a lot, let's say there is about half of auctions with an amount of about 1 ETH or even less. So if we have high gas costs to make these bids and win these lots, it will noticeably decrease our possible profits. So that's why we should decide whether to limit some, let's say, some lot amounts that we bid for, or in this case just limit, let's say, a maximum affordable gas price to pay for such bids.
Mm-hmm.
Yeah, basically how it works for a DEX arbitrage. There is a great research paper for from the guys that, if I'm not wrong, they created the gas token. It's a really interesting paper. They were doing this research for like a year, I guess, and they very precisely discuss this, as they say, as they name is PGA. Sorry, maybe not PGA, but gas price auctions. Yeah, something like this. So basically, sometimes this gas price to leverage this opportunity to be included in this block, so to make a profitable trade, it can be like a few ETH, like $1,000. So yeah, it should really depend on the expected profitability, and adjust somehow in this way. But yeah, and also it's why we should prioritize this as well, because if you look to other liquidations, to the other protocols that contain this liquidation logic, for example, Compound, DYDX, there is no auction there, so it's a restricted incentivization fee for liquidation, which is 5%, and there is a first come first serve. If you're set your gas price higher, you'll be in the block, and you'll liquidate. And there is interesting statistics from article. I don't remember who is the author of it, and there is information that like around even 80% of transactions are failing, who wanted to liquidate some collateral from DYDX. So there is strong competition there, and without this oracle, it would be I guess even impossible to participate in profit. But yeah, it should be studied more precisely, but I guess it's one of the priorities if we will add these protocols very soon.
Okay, shall we require the gas price oracle to provide a prediction of expected gas price in, let's say, in the next 6 hours or 2 hours? If yes, what? How many hours?
That's interesting question. How we can predict the gas price? There is that's interesting question, and but yeah, it may be important to perform this liquidation in profit, but it's more important to monitor not the network congestion, but the competitors, because I'm not sure that specifically the like general transaction fee is important more than that competitor is set.
Okay, well, first I would like to ask the question, let's compare the cost versus benefits, right? Can we use a gas price token instead of this Oracle?
Yeah, that was my other like suggestion, that yeah, if I understand correctly, usually it's not the prediction of the gas price, it's more like using gas token and to gathering this gas when it's when gas has a low price, and then use when it's like to make this bid. So it's a good question. Which is better? And
okay, well, one question for those who participate in the call: does anyone worked with gas price token or attempted get calculating the expected gas price at some point in the future? Did anyone does anyone have experience in this area from our participants on this call? If yes, please either unmute yourself and raise your hand, or maybe put in the chat. But the second one would be, what do you guys think if we ask community members for interest to participate in this gas price Oracle development, or maybe to lead this part of the parameters and bidding optimization? If someone has relevant experience, that would be great to get that person to help us with it, and maybe they will find a way to how to monetize that investment of their time to help us define the requirements, make the decision, or recommend the decision to the community what we should do or versus what we should not do. What do you think? Vadim?
As for the first part of question, I also will redirect this question to the chat in Telegram. Maybe someone there has this experience.
Yes, so I would say the main question right now, immediate one, and basically, what's the easiest way to get the job done, right? Maybe we can get around without building a new gas price Oracle. So that's number one. As far as the price feed, there are two requirements that I think we could put in front of the price feed Oracle. Number one is ability to filter prices, or maybe receive the feed where the prices are based on actual prices where liquidations, on venues where liquidations occur, not necessarily where the price for ETH or whatever collateral we're liquidating is now. Because on one hand, what's the point of getting a price if you cannot sell at that price, right? On another hand, if you limit the number of venues and you filter too much, right, you may not get an accurate picture of the market, because the price feed that you are, your usage, right, is determining the the bid price, right? And that bid price will affect the bid itself, but the current price is not necessarily represents your ability to liquidate the acquired collateral, because you will not have this collateral until the auction is over. So from this perspective, maybe we could ask the same question, cost versus benefit. Can we just use a standard price feed for, let's say, ETH, USD, and be done with it?
Yeah, because of that issue, we got the idea that we need to get more or less precise bidding result, and to know what is the exact, the correct amount to bid for. Let's say our bidding limits. We should use the expected lot amount in calculating this value, so we can avoid, let's say, price slippage. If we ask an exchange, let's say, for a 50 ETH of the lot, and then we can know for what price we could exchange it. So that's why we shifted to using in the formula this result of the calculation. I mean, the amount of the value of the lot in DAI, but not to use the price feed for a single unit of collateral.
Mm-hmm.
So we can use, let's say, price feeds for our purposes, not for a single collateral unit, but for all the lot amounts. And
Mm-hmm.
yes, and for instance, 1inch has access to different exchanges, and that's why we can compare and find a better price for us to use.
Yes. So one question here is that, do we need this oracle at all? Like, if we can, for example, assume that, okay, here's an average slippage in a normal market environment, right? Here's the average slippage for lot sizes 1, 10, 20, 50 ETH. So we get a formula that we could use on chain to determine the expected slippage and incorporate it into the bidding strategy without having a separate oracle for that, where we basically calculate expected slippage based on lot size and volatility. So if, for example, volatility is high, right, then assumption here is that we will be using some sort of like volatility oracle, or there is a feed for that, right?
It's not. Yeah, it's not a question of a specific or a separate oracle. If one of existing oracles can provide us with such data, it's pretty fine. So
yeah, well, what I'm seeing here is, let's say we for the lot size adjustment, right? Do we need an oracle at all? Like, okay, the higher the lot, the bigger the liquidation for this particular lot we're bidding on, or maybe even for entire amount of ETH that we're currently bidding on. Let's say if there are 10 bids for lots of 50 ETH each, total of 500 ETH, right? Then we basically increase the slippage by a certain factor, right? Like, I don't know.
Yeah, but it's hardly predictable in the moment because it depends on many inputs, such as specific exchange state, the amount of liquidity on it, and the market state, the velocity of the price goes down or goes up. So there are many factors, and that's why we would prefer to know the expected value for the total lot at a particular exchange, because if we are going in this example of let's say 10 auctions, it isn't said that we should win all of them, all 10 of them. So it's better not to calculate the accumulated value to know its exact, yes, its exact
okay, I understood.
price.
Can we get around by, for example, well, question about liquidations themselves, right? We discussed last week venues, right? And 1 inch was one of the options how to perform liquidations on multiple venues, right? What's the status of this? Are we going ahead? Is it in one of the next sprints backlog?
Yes, like a topic to research, to dive in. Yeah, we, if I don't mistake, we've got such a point to learn more about it.
Okay, so right now it's an investigation. How and what will it take to integrate? Right?
Yeah,
it's
correct.
It's not scheduled for implementation. Decision has not been made yet, right?
Yes, it's not. Yes, it's not scheduled.
Okay, understood. All right, got it. So I would say once that decision is made, whether to integrate it or not, then we can revisit the price feed, specifically the slippage issue, because if we end up deciding using 1 inch, for example, then we can look into what are the options available there, because they provide the slippage, right? Then there are alternatives like Paraswap and so on, right? If we can, for example, somehow get the slippage from there, right? When we make a bid, right, we could adjust it for safety, right? And say, okay, right now, when we make a bid, the slippage is, let's say, for this lot is 0.7%, and that is calculated by them, right? That's what they do. We don't have to do that. And if we can grab it and use it for the bids, at least it's probably will be good enough. If we make the bids not like for auctions that are gonna end 6 hours from now, right? But if we're making the bids in the last 30 minutes, for example, we can retain the risk of slippage increasing in 1 hour, right? Or in 30 minutes, right? We eat that risk, but we save on the need to have a slippage oracle or something, right?
Yes, yeah. This data can be safe enough. So, in a short, in the shorter period we have, the more precise data will be our expected. Yes.
Guys, sorry to interrupt you. Can you hear me?
Yes. Yes, Andrew.
You can think of slippage value as a fixed one, because it depends on the market conditions. When the market is falling, it'll be much greater than in the peace time. And I have a suggestion about the selling. First, I have a question. Are there any decentralized exchanges offering futures on Ether?
Yes,
because
there are.
Which one?
Future swap.
Future swap. So you can, for example, if we have 4 hours until the auction ends, we can sell the future on Ether as soon as we enter the auction. And we don't care, now we don't care about the Ether falling price because we have a future. As soon as we get Ether after the auction, we can buy back the futures and sell the Ether on that exchange. And you'll have additional, by doing this, you can have an additional edge before you're in front of your competitors.
So basically, if we don't win the auction, then what we do?
That's a question.
Okay, if we
but you can have some buffer, some cushion. You can have some cushion.
We buy back the future. So basically, we sell the future, right?
Yes, right.
And then if we win the auction, we buy back the future and sell the acquired, sell ETH acquired in.
But you have several options here, because auctions usually start when the Ether falls down. And by selling a future, you can have an extra income. It's not guaranteed, of course, but suppose the Ether falls 10%. You sell a future, then you buy it back. You can get an extra 10% income. To cover the potential risks, you can have some Ether cushion in the pool for such kind of cases.
But we don't have ETH in the pool right now.
No, you can have it.
We can, but it should be another pool then.
Well, it's just
well, that's a different problem, different issue, right? Whether pool allows ETH to be in the pool or not, if a new pool need to be plugged in or something, right? But what I'm trying to understand is that how would this arbitrage risk management using futures would work. So if, could you, Andrew, could you finalize this? Hold on, guys, let me stop this.
Yeah, and quick comment before Andrew will finish his thought. We discussed about like finalized decision. A quick comment that right now integration is on 1inch is in plans on our next sprint, which starts on Thursday, because our engineer Kostya Andrianov did a research, as I mentioned in the beginning, of total DexAG and 1inch, and we discussed like that 1inch right now is the best option among them right now for us. So if there won't be any other inputs for this decision, we will start like 1inch integration starting from Thursday. So yeah, if there won't be any other inputs, like considering today's discussion, for example.
Okay,
that's
very
quick
good
notice.
Very good. So Andrew, let's continue here. So to cover potential risk, you can have a cushion pool, but let's say, suppose you said, suppose ETH files 4% and there is an auction for 50 ETH.
Let's make it 100 Ether.
Okay, that's fine.
But by the way, why do you call Ether ETH? I checked the pronunciation. It should be pronounced like Ether. Oh, am I wrong here?
But it's just an abbreviation.
Yeah, I'm
okay.
reading Ether the same. It just ETH is ETH.
Yeah, okay. You're abbreviating to the fullest extent. Okay, let's discuss some scenarios here. The first scenario, the first one, you shorted the Ether futures. You sold the 100 Ether futures. for 100 ether, which you are trying to earn through the auction. The first scenario, ETH falls down like 10%. You don't win the auction, but you have the futures, and you have a profit of 10%. You close the futures by buying it back, and you have an extra income of 10%. The second scenario, you manage to buy the ether at the end of the auction. Ether falls the same 10%, and you have an extra income of 10% in the arbitrage, and you have an extra income from the auction. It depends on the price, on the discount you've bought it. The next scenario, the ether stays on the same level. You just buy back the future, you pay the commission, you pay the fees, and you close it at the same price.
Hold on a second, Andrew. I'm just finished writing down the first scenario. Okay, number 2. Okay. Scenario number 2, you short ETH futures, sell futures for 100 ETH, and then bid for 100 ETH in auction.
Yes.
If ETH raises,
how much?
By, let's say, 10%.
And you don't have the ether from the auction.
Let's say if ETH raises by 10%, and you did not win the auction, you won the auction, right? So let's say you did not win the auction.
So you have to introduce the risk management for this scenario. We have to analyze the daily volatility. In the cases, first we should filter out the days. I have some strategy I used for options trading and analyzing. We can discuss it a bit later, the specifics of this strategy. But in overall, you can filter out the days which resemble the day we are now. Let's say
resemble today's.
Yes, we should take a sample from the history of ether prices and filter out the same dates as we are now. And based on this situation, we should analyze the volatility, because volatility is not static. Well, the price, I cannot assume that the price of ether is stationary in statistics terms. So let's assume it's not stationary. It means that its volatility is changing. And if we take the overall volatility, we can catch an unpleasant scenario when we close our position by a stop loss, and as soon as we close it, the ether goes down. We don't want to find ourselves in this kind of situation, do we? So we should analyze the daily volatility, and we should place the stop loss a bit higher than the daily volatility for this kind of situation. Well, it's not guaranteed, but it will reduce the loss of going out from the market and then finding ourselves and then watching the market going our way. So we prove to be right, but we are not in the market. Well, it's a pity. So we don't want to be in such a situation. So we have to introduce the risk management and place a stop loss. this is the first way out. The second way out, as I spoken before, is having real ether in the pool, like a cushion. Let's make it, well, it's just a suggestion. We can make a diversified portfolio consisting of ether, DAI, CDAI, etc. Or other assets we want to participate in the auctions. So if we have ether, assuming we are not trading the full amount of our pool, it can be a decent strategy. And we don't have introduced any stop losses in the, here. If we have the ether, if we don't have it, it makes the strategy a bit more complicated, having to introduce stop losses.
Okay, let's finalize this second scenario, right?
You lose by 10%.
Okay, so you lose 10%, right? That's if you
10%.
If
but
you
10% not from the whole portfolio amount, but from the amount of the auction. It can be a small number comparing to the whole portfolio. So it can be a decent strategy, but you should take into account the, well, as far as I see the situation, you'll have very big liquidity issues when trying to sell ether right after you get it from the auction. Because if, say, you have 3,000 or 5,000 or 500,000 ether, and you put this amount on a DEX, you'll instantly cause a price slump there. So my suggestion here would be finding partners on the OTC market and making some, well, it's more complicated, of course, but you can trade on the OTC exchange if there are any decentralized, or you can use a centralized exchange, but it adds a different kind of risk here, a systematic risk. You understand what I mean? Or no?
Yes.
Do you get my point?
Yes.
You have two options: either use a more liquid market, central exchange, or more guaranteed decentralized exchange, but less liquid market, an orderless liquid market.
Okay, I understood. And let's say we win the auction, right? And the price of ETH raises by 10%.
You don't lose anything. You just because you have the ether, you have a physical ether, which raises the same 10%, and you sell it on the exchange and buy back the futures, and your clean return would be the amount you earned on the auction, in the auction.
So we sell this ETH at the profit of 10% discount plus 10%.
Okay, let's
and then we buy back
first you lose 10% on the futures, you earn 10% on the physical ether you earned on the auction, so you are you have zero profit here. You're even.
Well, no, we are actually, no, we're profitable because we're netting the discount.
Yes, you have a discount from the auction.
Discount.
Right. So it's a good scenario. The only negative scenario is the previous one, third one.
Okay, so pretty much the cost of this protection is the cost of scenarios where we didn't win the auction.
If I were a portfolio manager, I would take this strategy.
Okay, very cool. That's nice. It's actually becoming possible to implement this now. It wasn't possible, a year ago, but now with markets like future swap emerging, we can explore this.
Can you DM me the link to this exchange? I would like to have a better look at it. Okay, later.
Yeah.
In the Telegram.
Sure.
With this question on the time is the question is time. Right now they're in alpha stage, and they closed like they restricted access to the exchange because of huge demand for the last few days. So
to correct it, it's not because demand was too big and they shut it down. It's because the audit has not been completed. It wasn't published yet by Open Zeppelin, and the team at FutureSwap are still making changes to the contracts based on recommendations and findings of the audit team. And they didn't want to continue without publishing the audit and without open sourcing the code. And without some features that they're adding now. So they will expect to be relaunched, but the alpha 1 week of trading was very successful. I think they had over 7 million in volume, probably, or 10, 15, 20 or something. And they attracted over 1.3 million of liquidity from liquidity providers who did stake ETH and DAI. So that's becoming possible to implement what you, Andrew, described. It's really cool.
okay.
The problem the problem might be in feasibility, economic feasibility of using these strategies. Where the main limiting factor might be the fee structure of the future markets, such as future swap, may not be attractive for short-term buying, for short-term holding of futures, because I believe they have like a one-time fee. So in case they have a one-time fee, like similar to, let's say, Aave, where unlike Compound, you must
sorry
pay
to interrupt,
a fixed
Rinat.
fee, right?
One more serious issue here is the balance amount. I wouldn't like the situation of margin call. If you don't have sufficient funds on your account on this decentralized futures swap, you can get margin call easily if the price goes up. So you have to put some ether there. One more issue to discuss, one more question. How much? But you can think about it later.
Okay, got it.
So for example, if you have, it depends on the leverage, but I wouldn't suggest to use any leverage at all here because of the possible spikes. It also depends on the oracle which this decentralized exchange is using and the amount of time between the updates. If it's updated like every second, you can get a spike and have a margin call. But if it gets a bit updated like hourly or even on a more rare basis, it will be in our advantage because it eliminates spikes. One more question here is, for example, if you have 100 Ether deposited onto the swap exchange, and you sell 100 futures, you don't have any leverage there, so you can be on the safe side.
Okay, got it. All right,
It
cool.
again puts us in the question of having a cushion in Ether.
Okay, well, that is not a problem to have a cushion on Ether. We can accept Ether specifically for this arbitrage hedging strategy and split the profits pro rata between suppliers of DAI,
And one more
USDC, and
advantage
ETH based on how much profits were derived from operations versus how much value of the contributed ETH and DAI, let's say, I don't know, on a hourly or daily basis. And we can also adjust for the amount of risk that these guys takes, because ETH holders may not necessarily take the same risk by participating with their ETH versus those who may take or some other risks from the system. So that we should account for that, but that's my thinking.
Rinat, do you remember on the previous calls you talked about the strategy of bidding like 3% less than the maximum amount to outbid everybody else? You can implement this strategy with selling the futures.
Yes.
Easily. It can get an extra income to the strategy. For example, if the Ether goes down 5%, you earn 3% plus 5% from the falling Ether.
Okay, so you can bid basically with much lower discount.
Yes, and provided auctions usually happen when the price falls down, and the falling price, and here starts a self-sustaining cycle of the Ether falling down. If there are pretty much money locked in the vaults of the MakerDAO vaults, it can, I suppose, it can cause the price by liquidating these walls. It makes a pressure on the market and pushes the price even lower. So if you enter the auction as soon as it starts, you can have an advantage here. It's just, I'm talking about just a possibility, not a guarantee.
All right, understood that, because if this hedging strategy has certain profitability of its own, right? This means that keeper bots with this strategy have price advantage and can bid higher for ETH collateral versus keepers who do not have such strategy.
Let me put it this way. Just imagine you're a big whale having, let's say, 50 million in DAI. And you can influence the market with this money. I mean, decentralized exchanges. If you sell but the problem is the market mainly isn't decentralized. But assuming the DEX sphere accelerates and puts more weight on other exchanges, it can be a decent strategy. So what I'm trying to say is that by becoming bigger, you just secure more guarantee to win every strategy, every auction here by this strategy, by using this strategy?
You not secure guarantees, but you can increasingly have a higher probability of dominating the
Yes,
market.
you increase your influence. You increase your influence and make the expected value higher. Expected value in math terms, in mathematical terms. So the probability becomes higher, much higher. The more money you have, the more profitable it could be. But we should analyze every possible scenario here, because there could be some hidden bugs.
Okay, understood. Very cool.
One more question about the gas prices and the gas token. Since you were asking earlier, I would like to ask everybody in the conference call here, does the gas token allow to be bought and sold like an ordinary asset, other crypto asset, or it can only be bought and then implemented in the smart contract? I mean, bought back, sold just by using the smart contract.
Yes, I think so. So the question is, can gas token be bought, sold by smart contract?
No. The question is, can the gas token be bought from the smart token, but sold on an exchange, on a third party, on the secondary exchange, or is it sold only through the smart contract?
And sold on another venue. That's your question?
You know, I'm not technically savvy here, because I've just had a look on how the gas token works maybe a month ago, and as far as I understood from the papers, it can be bought on the secondary exchange, or it can be bought by a from the smart contract, and then later it can be sold again using the their smart contract. Correct me if I'm wrong here.
Okay, yes, I don't know the answer. What's the liquidity on gas price token outside of the issuing smart contract, and whether there are markets on like Uniswap, but I assume that if you can buy it on secondary exchange, that's where you can sell it too, right? Because someone must be selling it on a secondary exchange. So,
but as far as I understood, secondary exchanges have great slippage and not good price.
Okay, so what are you trying to get to?
I'm trying to make the maximum, trying to find the maximum return. For example, if it can be, well, just I was thinking from the point of view of an investor or speculator. I bought gas token on a secondary exchange, so I can't, I cannot spend it because I don't have to spend it on a transaction. I can only spend it by selling on the secondary exchange, but you're not in the same situation as an ordinary investor. You can spend it by in a transaction. So by spending it in a transaction, you can have an extra return, if you understand what I mean.
Mm-hmm. Okay, the keeper pool, basically, unlike these investors, speculators, the keeper pool can actually use it in transactions, right?
Yes, that's a good news.
Which allows the keeper pool to potentially buy the gas token at a discount, right?
Yes, right.
Versus the price you get as a seller who can't use it. Okay, understood. Well, with more protocols using the gas token, like I believe 1inch, this is how they use it.
Also, if I'm not wrong, they also had plans to integrate our Ethereum, and are both solutions are compatible, or it is necessary to pick one of them? But they had plans, or even they integrated our Ethereum to provide this gasless operations. But I'm not sure how this works using 1inch right now. But I know that they had some plans to do it.
Okay, that's fine. All right, guys, let's move on. So mempool is a bit more complicated here, but what would be, well, I can specify the items here. Let's wrap up, and we're past the hour. Quick update on the grant applications. One of our team members, Elena, she took the initiative of drafting the application for grants to with the goal to gauge interest of maker community in actually seeing a more formal grant application. So immediate objective is to prepare a draft which outlines the key elements of it and run it by members of maker community with the goal to get their feedback or score, as if you will, on a scale from 1 to 10, how interested would the community be in seeing a formal grant proposal, how important the potential outcomes, right, that Keeper Pool, if assisted with its roadmap, how important are these outcomes that it could help deliver, how much value they place on getting these outcomes to the maker community, like the backstop, buyer of last resort, right, and so on. And by next Tuesday, we should have a draft, and hopefully we will run it by some of the maker people who are present in our Telegram chat. And see what they think. So next update on this will be next week. So with that, thank you. I'm done with my part. Anything else, Vadim? Do we have an agenda?
No, we don't have any other questions on the agenda, but maybe there are any other questions from the community side. Do you guys have any questions to ask? If not, we can wrap up. Yeah, it was pretty productive brainstorm of selling strategy, I guess. Thank you, Andrew. It was really interesting how we can solve a few problems with involved to sell the collateral. So yeah, that's pretty it. Thank you, everyone. You can try the Keeper Pool product right now. So go to the Telegram chat, to the pinned message, and check the site, and you can request the access there, and our team will reply to you shortly. And yep, that's all for today's call.